Hi there, it is Dan Curtis, DK Analytics. It is December 20th, 2018. Thanks a lot for tuning in. We're coming back to you after a lengthier video 2 days ago on the 18th, on the heels of the Federal Reserve Board's tough love that it disseminated yesterday, December 19th. Specifically, Fed head Powell poured cold water on investors expecting an end to Fed fund rate hikes as the Fed funds was raised as expected by a quarter of a point to a midpoint of 2.375% effective rate. Powell did, however, suggest that there would be only 2 rate hikes in 19, also surely at 0.25% a time, which would be half of this year's 2018's pace, and thus through stock investors a bone. Or forebodingly, for bubble investors, which in essence describes most people still hanging out in overvalued bonds and stocks, or the vast majority of investors, at least in US markets. For bubble investors, Powell brushed aside any speculation, given the mounting evidence of a weakening economy, that the Fed would reduce, much less end, its $600 billion annual bond sales program, which has been placed on autopilot, which is also known as QT. Well, the stock market didn't take that news too well, and it resumed its fourth quarter slide as aggravated by government shutdown threats growing louder. More on that in a minute or two. As I mentioned 2 days ago, during my quote, global central bank QE morphs into QT in 2019, unquote, video, reducing liquidity and adding to the supply of bonds amidst gaping financing needs, and Chinese and Japanese no longer stepping up to the plate and even selling U.S. bonds, and institutional U.S. investors unable to continue to absorb everything, at least not at these yields. Those kind of budget deficit financing needs of $1.3 trillion in fiscal 2018, not the federal government deficit as posted, but the actual deficit if one looks at the increase in U.S. government debt year over year. So this is before even more pronounced financing needs that will result as we slide into a weaker and weaker economy, and the statisticians can no longer pretend that we're not in an official recession, which we would be and would have been had we had an accurate reading of the inflation rate, but that's another story for another day and one I've told before. More to the point, with the central bank insisting on expanding the supply of bonds, in addition to sales of sovereign nations, juxtaposed against mounting deficits that are only going to skyrocket as the economy grows weaker and tax receipts decline and social transfer payments increase, we're going to notice sooner rather than later, that is in valuations, that this isn't how one sustains the unsustainable. That is our current trajectory in asset prices, most especially. That is, this is not how one kicks the can even further down the road. In a statist, extremely bureaucratic, very misallocated, property rights eviscerating, weak productivity, extremely heavily indebted world, heading into a recession, progressively weaker asset prices, including many bond and stock markets, isn't how you sustain the very bubble economy that A, prevented what would have been a necessary asset value collapse and an economic collapse, and B, those same bubbles which have made the day of reckoning all the worse. In short, what is in store for us all, and that is what the Fed, through its QT, is now hastening to bring about. U.S. stocks, at least as measured by the S&P 500 index, which is down only 7.5% year to date, have outperformed most of the globe's spreading bear equity markets. Yet, with a progressively weaker domestic economy, perhaps best captured by declining home and car sales, worsening consumer liquidity, one new consumer debt record after the other, nearly 14 trillion at last count, according to the New York Fed, which is up for 21 straight quarters despite progressively lower home ownership rates, and also something captured by rising labor market stresses. I'm referring to a progressively weaker domestic economy. Those rising labor market stresses, despite the so-called record low U3 unemployment rate, are best indicated or captured in the increasing, more encompassing U6 unemployment level, and especially at SGS's shadow government stats alternative measure, which is in excess of 20% in terms of real U.S. unemployment, and captures those job seekers that have continued to look for work but have been unable to find it for a year or more, which used to be in the U6 statistic about 24 years ago. In essence, rising consumer debts have financed spending out of an increasingly empty American pocket, featuring plummeting savings rates prior to the statisticians revising the number to make it look less bad. Perhaps more pointedly, according to a Fed report of relatively recent vintage earlier this year, some 40% of all Americans are said to have less than $400 in accessible available savings. This situation mirrors the poor disposable income on tap, which, in real terms, fell during the month of November in sympathy with a declining work week. Meanwhile, on the out-of-control federal government spending side, with one record federal government spending year following the next, against a backdrop of nearly $22 trillion in operating debt and a $1.3 trillion true deficit in fiscal 2018, ended October 18, which is heading towards $2 trillion, the Republicans, still in control of both chambers of Congress and the White House, have been unwilling to even attempt to force some modicum of spending restraint. And this even under the false guise of a government shutdown threat, where some 80% of the government remains open, all payments continue to be made, all creditors get paid, furloughed government workers get back pay, and no spending gets cut. Meanwhile, the Republicans, once again, have displayed zero spending discipline backbone with their continuing resolution funding stopgap measure, which mandates zero cuts. And this is before even more spendthrift Democrats retake control of the House in January 19. And what the Republicans have achieved with their wasted, lost opportunity is an out of control government in terms of size of spending and deficits, and an economy that's going to roll over badly. They're going to get the blame. Trump didn't leveled with the people while he ran for office, but has now taken ownership of bubbles, of greater government spending, of higher government deficits. This is what the socialist Democrats that may well swing back into power when the economy's in the shitter in 2020 will blame so-called capitalists for this mess, when in essence it'll be more cronyism and statism and redistributionism that is what's at fault, not a lacking free market capitalist system. But this, the Republicans' failure, this is my point, will, in my opinion, almost guarantee a Democratic victory in 20, possibly at the presidential level and at the Senate. We may end up with full-blown socialism as a result of the squandered opportunity that the Republicans had. That is a huge, huge threat for the economy and for asset values. So there you have it. In a nutshell, the Fed continuing to take away the statist / crony / redistributionist / massive third world amnesty punch bowl. Yet our federal government is hell-bent on running into a financial brick wall as progressively higher trillion-dollar-plus deficits are added to unrepayable debt and rapidly growing Social Security and Medicare payments to an aging population. As there is no way, politically viable way, that the U.S., much less the OECD world in general, is going to return to fiscal sanity, sound money, and stout property right protections, not having the bureaucrats spend cause $2 trillion of private sector spending each year, and the 2 million that are employed there. But the property right protection eviscerations for maker citizens, together with the other factors lacking fiscal sanity, no sound money, much less a return to incentives to save, such as an interest rate made for creditors, not debtors, and to invest, and thus to underpin the very free market capitalist system that would enable a return to a wealth of nations productivity elixir, is sadly not in existence, not on offer. Therefore, the Fed's decision to hasten a stock and economic meltdown simply reiterates the dramatic need for investors to sell overvalued bonds and stocks wherever in the world they may reside, because when this global bubble truly pops, there will be few places to hide. In a related manner, I underscored the rationale for moving from bubble valuation FANG stocks, Facebook, Amazon, Netflix, Google, to value stocks. That is, if you must remain invested in stocks, then go from FANG to value. And I did this in a September 20th, 2018 post number 47. Let me offer some specifics just for the fun of it. and also as a warning for people still hanging out in overvalued stocks. I think this is the first shoe to drop. I think there's going to be a lot more. So it's better to get out a bit late than never is the motto here that I'm trying to sell or promote. From September 20th, 2018 until today, or midday today, December 20th, also 2018, Facebook has dropped by 20.4%, Amazon by 25.9%, Netflix by 30.7%, and Google or Alphabet by 47%. Some fangs. These declines took place in 3 short months. Meanwhile, in the value camp, over the same time period, where I took 3 stocks that were featured as value stocks courtesy of Motley Fool write-up, at time AT&T or T is down 15.6%. Disney is down 3.9%, and Horizon Pharma is down 1.1%, while the S&P 500 is down 15.4%. Upshot, quite the divergence between mega high PE and relatively low PE stocks, which is the point we're trying to make. Get out of harm's way. I offered this stratospheric PE versus value stock comparison to make a top-down valuation and allocation point without doing any bottom-up work on any of the stocks. By the way, I spent 2.5 decades of my investment career in the bottom-up world, so I have considerable familiarity in that arena. But I think we have to paint this with a top-down brush, given the fact that we have eviscerated price discovery thanks to financial repression. And valuations are so pie-in-the-sky dangerous that you will not be able to avoid getting out of harm's way if you remain invested in some of these tremendously overvalued asset classes. But if you must, then pick the cheaper stuff, not the more expensive. Pick the value stocks over the insanely priced, even to this day, FANG stocks. The point was, in essence, to draw to people's attention how vulnerable their capital or their unrealized capital gains were to insanely valued, insanely priced stocks. I made a similar lookout below call on December 12th, 2017, a bit over a year ago, namely in post 23, which was on crypto wannabe currencies versus good money, precious metals. That's post number 23, readily accessible if you visit the dkanalytics.com site. On that day, December 12, 2017, Bitcoin was trading for $16,568. Today, it's $4,101. That's 75% lower. The same value at risk, in my opinion, holds true in corporate bonds via widening yield spreads to treasuries and stoutly, and thanks to stoutly deteriorating credit quality / balance sheets. And ultimately, the same risks will hound investors positioned in our vastly overvalued long-term government bonds, which, as I stated the other day, are junk bonds without junk yields. Bonds where either insolvency or debasement risks, money printing risks, threaten large capital losses and or material loss of purchasing power. We've been there, done that in the stagflationary 70s, which I think we're going to repeat on steroids given that we have a lot more ugliness to contend with at the financial, economic, and political level than we did back then. In a nutshell, much lower productivity, much higher debt, and much less rule of law of property right protections. Most government bonds aren't safe havens. They are Potemkin village assets. They appear to be sound, but they're not. Only physical gold and silver at attractive prices in counterfeit/fiat currency terms, such as today, are safe havens and simultaneously offer huge capital gains appreciation potential given their mispricing, whether it is a misconception or a manipulation or both. In a nutshell, I wanted to briefly chime in on the Fed's rate decision and its adherence, at least so far, to QT. I also want you to know, for what it is worth, that I haven't forgotten about that REO, return on equity decomposition video. I'm working on it as time permits. I would like to end this video with two observations. Number one, the firmer the Fed sustains its tough love, despite the pathetically low federal funds rate, but the dramatic turnaround in its balance sheet, the unwind of its balance sheet, the longer it stays on that, the faster we're going to have a reset of asset prices, because it will bring on, speed up, hasten the financial and economic train wreck that we are overdue for. The second observation, and a distinct one, unrelated to the title of this video, Fed Tough Love, on December 19, 2018, as reported today, December 20th, 2018, I'm referring to a political observation. Hey, I majored in philosophy and economics in college, so forgive me, but I think you'll find it of interest and hopefully of use. It is both encouraging and discouraging. I'm referring to a recent Gallup poll after last month's midterm elections in the U.S. that offers one indication of at least a healthy cohort of remaining intelligent life amongst the U.S. population. The poll asked Americans what they thought were America's biggest problems. Their response, 19%, 19, said government, 16% said immigration, Mr. Trump, that wall, 8% said unifying the country, 7% said race relations, and only 5% said the environment. Too damn bad that we no longer have representative government. Bureaucracies, unelected, unrepresentative bureaucracies make our laws. And too bad we don't have elected officials or politicians that keep their election promises. And too bad we no longer have a constitutional republic featuring stout fidelity to separation of powers, federalism, and inalienable rights, which give us a small, manageable government and ultimate maximum freedom. Too bad that we've morphed into a mobocracy, greased by the very printing press that has given us a bankrupt welfare state. The founders of this great country and the framers of the same, and they were one and the same in most cases, feared a democracy, that is, tyranny by the masses, nearly as much as they feared autocratic rule, tyranny by the minority or by a king. Today, we sadly have both competing for supremacy, mobocracy and some kind of autocracy, meaning that we no longer have a republic, much less a constitutional republic, nor free market capitalism, nor a wealthy nation, nor a wealthy West, but rather an insolvent welfare state and an insolvent welfare West where individual freedom is disappearing to achieve societal equity. Sure. How does one spell a recycled Marxist canard? I'm going to leave it right there. Close by wishing you once more a very, very Merry Christmas and a happy and healthy and prosperous 2019. I hope to chime in once more before the year's out. Otherwise, see you next year. Bye-bye.